episode of our financial education series here. We have been talking about lots of different topics over the last several weeks. We started out talking about the things you need to know about investing, the two biggest mistakes people make, and then we've been going into all of these what we call major wealth transfers, transferring away money unknowingly and unnecessarily. We say that it's in your blind spot. You don't even know about it. So we've talked about mortgages. We've talked about your qualified plans. We've talked about your taxes and how to save for your kids' college. And now we are going to conclude this little section on major capital purchases. How you pay for things is one of the major wealth transfers. Now, this is something that applies to everyone. And I like this one. It's actually probably one of my favorites because it applies to so many people. Sometimes I meet with people who don't have a mortgage, and so maybe the mortgage section or piece doesn't apply to them. Or maybe they don't have a qualified plan. Or maybe, of course, taxes pretty much affects everyone, but maybe they don't have investments that are being taxed on an annual basis, and so maybe it doesn't apply. But in most cases, and of course maybe they're not saving for their kids' college, but in almost every case out there, you will be making large capital purchases. Now, this is something that is very important, and it can be one of the main wealth transfers. Of course, that's why it's one of the top five. But we've looked at this. Some of this in the beginning will be a little bit of a review. With the private reserve strategy, we have talked about this in some of these other sections because this kind of intertwines into all of the subjects that we've been talking about. However, we are going to go into this in a little bit more detail as it pertains to making large capital purchases today. So the private reserve strategy, once again, as a review, is a strategy designed to help you accumulate an increasing pool of capital while still providing accessibility. Remember, of course, the one of the two biggest mistakes people make with their money is they don't have access to it. So, of course, we want to have access to our money with this private reserve strategy. The second biggest mistake people make with their money is they interrupt the compounding. Compound interest works best over time. So this private reserve strategy actually accomplishes those two, or avoids those two mistakes while allowing your money to accumulate but still providing access. And, of course, we do that through collateralization. So we will get into that in a little bit more detail, but you probably remembered the tanks. We're going to not go into that right now. But as far as wealth transfers and as far as these major wealth transfers we've talked about, some of them you can avoid and some of them you can only minimize. So, of course, you're going to finance everything you're going to buy. I can show you how much it's going to actually cost you to buy a car, but that doesn't mean that you're not going to buy a car. So we can't necessarily avoid these wealth transfers, but we can minimize the wealth transfers because you will finance everything. You're either going to pay interest to somebody else for the use of their money, or you're going to give up the interest that you're earning on your money. So every dollar that's not saved is consumed. Now, there's a lot of things that affect that. We call it the economic squeeze on your capital. First of all, there's external pressure like inflation. That, of course, erodes your purchasing power. In 1980, a dollar would need to have $2.65 in 2010 to buy the same thing that a dollar would have in 1980. So that significantly affects your capital. The other thing is internal pressure, like consumer debt, for example. This is getting to be it's been a problem for a long time now, but consumer debt is definitely hurting people because, of course, it kills the compounding. And, of course, your debt can quickly snowball out of control. And, of course, that creates an economic pressure that affects people's purchasing power. So there's the savings efficiency. We talk about this in the very beginning with everybody we meet with. And this is the paradigm shift in how you think about saving money. Everyone is so focused on the amount that they're actually saving. So if somebody's making $100,000 a year and they're saving $6,000 a year and they're getting a, let's say, 6% return on that money, then that is, of course, $360 a year in interest. That's the power of compound interest. But everybody keeps focusing on this number. Everyone's always trying to get a better rate of return. And by getting a better rate of return, it literally gives you an extra tank of gas is all. So it doesn't help you a tremendous amount. Now, of course, over time and the power of compounding, we all know that it does make a difference. However, it's not as big of an impact as what we call reducing expenses and how that can be a lot more efficient. So we can look at that $96,000 and look at all these wealth transfers that we've been referring to, and if all we do is even shave off a couple percent of that $96,000, that's $1,900 a year. That's a heck of a lot more than the less than $100 that we got by increasing our rate of return. So that's why we don't focus so much on rate of return and why we consider that to be less important than some of these other areas of focus. And so by reducing our expenses on that $96,000, we are going to save a significant amount more. And then, of course, that would be the equivalent of a 32% return on the $6,000 you were investing before you saved that $1,900. Just a different way of looking at it. Now, some of this is a review, like I said, but some of this we're going to get into is a little bit new, and it's going to actually quantify and show you some numbers behind just how much of a wealth transfer this all can be. So before you pay for anything you buy, whether it's a car, a boat, a vacation, anything that you make as a large capital purchase, you must consider not only the amount that it's going to cost you, but of course the opportunity cost. It's not just what you pay for, but how you pay for it, and that can be a major wealth transfer. That's what we're going to look at. This we have looked at before. If you have $30,000 and it's earning you 5%, and you are considering spending cash for a purchase, then over a 5-year period of time, you could have earned $8,500 in interest. So if you give up the use of that interest, or if you give up earning that interest, then of course that's an expense. You're going to transfer away that $8,500 of interest that you could have earned if you decided to pay cash. So of course, if you borrow the $30,000 at 5% and pay a monthly payment, and of course you factor in the principal, the interest, and the opportunity cost, and all that, the factors, and you look at your total cost of ownership, it's $38,501. So to spend cash, it's going to cost me $38,501, and to borrow the money from somebody else is going to cost me $38,501. Now, when we get into this being a wealth transfer, like I said, you can't avoid it. We can't avoid the fact that we either have to pay cash or we have to finance it. In this particular case, it looks like it doesn't matter which one we do because it's going to cost us the same. But when we refer to it as a wealth transfer, that's because what if you were getting a 6% return, and what if you could find other money for 4%? Now all of a sudden, we are looking at a wealth transfer. In this particular case, we're looking at a couple grand over 5 years. You spread something like that over your 30 years of purchasing things, and that can be a significant wealth transfer. Now, one of our favorite screens is the idea between buying, borrowing, paying for things. When we are a debtor, of course, we have no savings, we earn no interest, and of course, we just pay interest. And that's, of course, a situation that no one wants to be. But a saver avoids paying interest to others, so they save, they earn interest, and then they pay cash for everything, which means they basically give up the interest that they could have earned. And of course, the wealth creator is what we're going to be talking about. The acronym OPM, you've probably heard before, is using other people's money. Now that is the secret, and that is what we are going to talk about today, and that is how you save, you compound interest, and you collateralize your purchases. Now we have talked about this before, and the same thing applies to borrowing and paying for things. Now this is the favorite screen that represents what it is that we're referring to with this conversation. A debtor starts at 0, gets into debt, he gets back to 0, but then he keeps doing that over and over and over. Now the saver delays gratification and earns interest, but then he spends that interest, giving up the ability to earn additional interest until he builds that back up, and so on and so forth. He ends up at 0. And then, of course, we have the wealth creator, the picture that is worth 1,000 words, literally. Now, you've seen a lot of this before, but today what we are going to talk about is this particular number here. The reason why we call this a wealth transfer is because by not applying this strategy, this wealth creator strategy, and this private reserve strategy that we keep referring to, what is that amount? What is the number between here and here that you are losing or transferring away unknowingly and unnecessarily? In other words, if you were able to allow your money to continue to increase, like I started with in the very beginning as far as the definition goes for the private reserve strategy, if you are able to allow your money to grow uninterrupted without, draining the tank or paying cash, then what is that dollar amount to you at the end of the day? And that's what it is that I want to talk about today. The problem with consumer debt is you're simply using future earnings to pay for that debt, because by definition, debt is when you purchase something that you don't have the money for. So if you don't have enough money to pay cash for a car, then you go into debt, and of course you are obligated with your future earnings to pay off that debt. Now, of course, you lose capital because you are financing those expenses, and you're paying interest to someone else. And of course, you are in debt to the debtor. So let's look at this with a very common debt, of course, we know as credit cards. Now, a lot of people know that credit cards are bad, but a lot of people also don't know just how bad credit cards are. Now, some of you may have done the math, and you may have calculated just how much interest you would be paying over time if you had a $10,000 balance that was costing you an 18% interest on your credit card, and for a minute, let's just say you are going to get 7% on your investment somewhere else. Well, you may have done the math and figured out that that $1,900 a year in interest is a lot of interest. But of course, you can manage that. That's less than $200 a month, so you can afford it. But at the end of the day, how much is that costing you over time? Well, if you do the math and you add that up over the years, that's $78,000 over 40 years. If you just paid the interest on that $10,000 credit card. So $78,000 in interest in order to use somebody else's $10,000. Because remember, you didn't have the $10,000. So that's why you had to go into debt. And so you put $10,000 on the credit card costing you 18%. And that, of course, over a significant period of time, like 40 years, added up, that is a lot of interest that you are paying. Now, most people stop there. All they focus on is this section right here, which is the amount of interest that you pay over a significant period of time. However, the real question is if you could have been able to earn that $1,972 in interest, earn interest on that $1,972 a year. In other words, if you were not paying that $1,900 a year and you were investing that $1,900 a year on the 7% return, then that credit card cost you $393,000 out of your retirement years, out of your retirement income, out of your future income. So the problem with debt is not just the interest that you pay, but it's the opportunity cost that you lost on that interest that you're paying. Now, of course, you wonder why you get so many offers for credit cards in the mail and how they can afford to kill so many trees and send out so much mailing. Well, the reason is because, of course, they're taking your $1,900 a year and they're investing that, or I guess not even investing that, they're taking your $1,900 a year and you're paying them actually. You're paying them 18%. So over 40 years, you paid that financial institution $13 million to use their $10,000. That is crazy because they can turn around, of course, and at an 18% return over 40 years, that is a lot of money. Now that, of course, is what we're trying to minimize or even avoid. And that, of course, is the problem with debt. So, of course, what's the solution? Most people would say pay cash. And paying cash can sound like a much better alternative than, of course, going into debt, because as we just saw, debt is bad. However, here's the problem with paying cash. First of all, you have to save the money, because debt, of course, is when you don't have the money. So paying cash, we have to save the money. So we fill up our tank. And, of course, if we fill up our tank, then as we fill up that tank, we fill that tank up usually with earned income. Now, earned income, we have to pay taxes on. So, of course, we have this annual tax leakage where if we were looking at an initial account balance of $50,000 and we're getting 5% on that money and it's being taxed, and we could have earned 5% on our investment, and we're looking at it over 30 years, that is a very significant amount of taxes that we are paying to save money or to pay or to save cash. It's like $109,000 that we paid just to be able to pay cash, or to save that money, I should say. Now, the other problem is that you have to drain the tank to make your purchase. Now, draining your tank means that you are interrupting the compound interest. And if your cash was earning 5%, then every time you drain that tank, you give up the ability to earn that 5%. So that is one of the major problems with paying cash. So you lose the interest you could have earned if you didn't drain the tank. So I told you a minute ago that we would look at exactly what the cost difference was between our favorite screen back here, this one, right here. So what is the price difference, or what is the cost? What is the opportunity cost or the wealth transfer between this number up here and this number down here? Well, to illustrate that, we have this tool where we could look at $5,000 a year going into this account or into our cash, where we could be earning 5%. Now, of course, you may not think you could earn 5% because you're used to putting money in a bank. Well, a bank is not the only place to earn money. So let's just suffice it to say for now that we could help you get a 5% return. So if you could get a 5% return and you have 30 years that we're looking at, but we keep draining our tank 5 times, and of course it takes 4 years to refill that tank. So what you see down here is that this red down here represents the saver scenario that we looked at earlier. Remember, the saver builds up cash, then drains the tank, builds up cash, drains the tank. So this is what the actual saver does. Now, we already know what the debtor does, but the saver saves money and then drains the tank. Okay? Now, the wealth creator is this green line, and that represents, of course, your money without interrupting the compounding. So if you don't interrupt the compounding and you are saving $5,000 a year at a 5% return over 30 years, that would be $353,000. And if you waited until later to finally figure this out, and you didn't have as much time, you're only looking at $71,000. That's what that number represents, is waiting until later. So, of course, the difference in waiting and figuring this out later, which is why I'm glad you're on this training today, but the difference is a $282,000 difference. Now, we're looking at this over a 30-year time frame. This is something that everyone needs to learn before they even make their first purchase out of high school. I mean, this is something that could be avoided or minimized starting at a very early age. It's something that I think everyone should be teaching their kids from a very early age, because everyone will be making purchases in their life. They may never end up having a qualified plan, and they probably will have a mortgage, but they may not. But everyone will be making major capital purchases. So this is something that everyone needs to understand. This is very powerful. So the difference here, and that amount that we've looked at before in the other diagram is literally $353,000 over 30 years at 5%. Now, is it possible to get 6%? Absolutely. And over 6% at a 6% return over 30 years, we're looking at $424,000. So, of course, this is just back to the power of compound interest. Now, this is a very powerful screen to explain the true cost of emptying the tank and resetting that compounding cycle. So that is a significant effect on your future wealth, and that is why this is categorized as one of the top 5 wealth transfers that someone makes or does with their money. So consider this. What if you could make the purchase without emptying the tank? What would that be worth to you? Well, in this particular case, it would be worth over $400,000, or at least over $300,000. What would that be worth to you? So if you don't use your capital, then who do you use? Well, you collateralize a loan from a financial institution, securing the loan by pledging a portion of your private reserve. Let's look at what that looks like. So here is my private reserve that we've been talking about. You may remember, the tanks over here. So if we've built up our safe tank here at 5-6%, which is safe and protected, okay? So if we build up that tank, so now we have our private reserve here. How do we use that money without draining the tank? Well, very simple. We go to a financial institution. Now, I'm not saying what financial institution. We're not exactly saying a bank. We're just saying generically, we're saying a financial institution. So if we go to that financial institution and we borrow money from them, generally speaking, some financial institutions, like banks, do require an amortizing loan, which means that you have structured payments. That means, of course, that you are required, to make those consistent payments every month. But you could use your money as collateral. Now, do you always have to use your money as collateral? No. You might be able to use the car as collateral. You might be able to go and get a car loan without using your money as collateral. So if we don't have to use our money as collateral, we don't want to use our money as collateral, because then that gives us the ability to use our money in the future as collateral for something else. But what if you wanted to borrow money for your daughter's wedding? There's a good chance that the bank is not going to require your wife, or your daughter, to be used as collateral, right? Because they'd have to sell her to get their money back for the wish. It doesn't work, obviously. So you could use your money as collateral to pay for your daughter's wedding. That's a major capital purchase for some people. So if that's a major capital purchase, we've already seen what that does if you go into debt or if you pay cash. So we could use this particular collateral position for something like that. Now, the other thing to consider is what we call this collateral capacity. How much can you use as collateral? Well, it depends. There are 3 things that factor into that. Contributions. As you put more money in to your tank. In other words, as you add money into this safe tank every month or whatever it is, then that increases the amount that you can use as collateral. The other thing we're going to have is the beauty of compound interest. Our money is always earning interest because we never interrupt the compounding. So if we never interrupt the compounding, then that, of course, gives us additional collateral capacity. Everything you see in green represents my collateral capacity. The yellow represents the collateral I've already used. So I can't use that again. That's already securing a loan somewhere else. The other thing that we can do is, of course, we could pay off that loan. If we used our money as collateral, then we could pay off that loan and reduce the lien amount, which, of course, frees up the ability for future future collateral, or collateral capacity. And then, of course, we can also increase the tank size by just keep putting more and more money in, which, of course, allows us to do this over and over again. So the private reserve, we've talked about some of the ideal characteristics before. I'm not going to spend a lot of time on this. I want to get to another topic to kind of close up with. But there are several characteristics that you would want in this private reserve account. We want our money to grow tax deferred. We want to be able to pull it out tax free. A competitive return on our investments, high contribution, a deductible contribution, collateral opportunity. Safe harbor means it's protected from creditors, lawsuits, bankruptcies. No loss provision means guaranteed to never lose money in the market. Guaranteed loan option means you can access the money anytime, guaranteed. You can get a loan guaranteed without credit check or application process. Unstructured loans, this is what I want to kind of wrap up with. We want to talk about that in a little bit more detail. But that is extremely powerful to be able to have an unstructured loan payment, and then, of course, liquidity, use, and control. Now, there are several benefits here listed. I don't know anyone that wouldn't want all of these benefits. Unfortunately, some accounts work better than others, so we don't get all of these benefits with every account that we choose. But we have looked at this before, and we have seen that out of all of the accounts for this particular strategy, now I want to make it clear that these other accounts are not bad accounts, but for this particular strategy, this private reserve strategy, the one that works the best is simply a very specific type of life insurance. Now, this is not any life insurance. This is a very specific type of life insurance that gives us all of these benefits. The only one it doesn't give us is the deductible contributions, because if we're going to have the money grow tax deferred and pull it out tax free, we cannot deduct it in the beginning. So, unfortunately, there's no non-taxable investment out there. We have to pay the taxes somewhere. So in this particular strategy, we have talked about how we are going to use the life insurance for this private reserve strategy. So what we are going to do is we are going to use this life insurance, which of course comes with an added benefit of the life insurance death benefits. That's an added perk. But we are going to use this account with this life insurance policy to grow our money to be used as our private reserve. There are some very significant differences with this strategy, and that is our insurance company. We can use the insurance company and their money as to borrow money for what it is that we are purchasing. What is different, you'll notice, is it's an interest-only loan. It's not an amortized loan. So this interest-only loan is a very significant difference. And, of course, once again, since our money is already with the insurance company, it's just a matter of a phone call. We call them up, say, hey, we'd like to use, part of our money as collateral to secure a loan for whatever purchase it is, and they don't care. You could be honestly using the money to invest in time travel, and they wouldn't care because your money is being used as collateral to secure that loan. So you get this interest-only loan for whatever it is that you want to purchase, and here is the beauty of it. This is all the difference in the world, and that is a non-structured payment. That means I had a client the other day that said, oh, I would much rather use cash than borrow somebody else's money because I hate to worry about, not making that payment and paying it late. And then if I pay it late, they ding my credit, and I have all these fees and all these other things. And so this non-structured or unstructured loan payment is extremely powerful for large capital purchases. So, of course, since we're talking about large capital purchases, this is huge. Now, this doesn't mean you don't pay it back. This just, but technically, I guess you wouldn't have to, since it's just an interest-only loan. It would just continue to accumulate interest. But it's an unstructured loan payment, and that non-structured loan payment means that it's on your terms, and on your terms makes all the difference in the world. When I ask someone, if I'm going to give you a loan, what are the two things you want to know about a loan? Everyone says the interest rate and the term. In other words, how much do I have to pay? When do I have to pay it? Now, the interest rate still applies here. The insurance company is still going to charge you an interest rate. But when they don't have the terms associated with it, meaning you can pay it back whenever you want and however you want, that is very significant. Now, we don't always, for this private reserve strategy, we don't always have to use the insurance company. We could use a financial institution. And the financial institution might give us a loan for a car, and we have an amortizing loan, which of course means that we have specific payments that we have to pay, and it's a structured payment, but we didn't have to use our money as collateral. So if we go to a financial institution and not have to use our money as collateral, then that's fine too. But the difference between, let me go back here, the difference between the insurance company and an interest-only loan and a non-structured payment versus the financial institution and an amortizing loan and a structured payment, that might be all the difference in the world. Maybe you're a business owner and you have an inconsistent income or a seasonal income. Maybe you're a business owner where the winters are really slow because you're in landscaping, and your winters are really slow, but your summers are really good. Wouldn't it be nice to make all of your payments during the summer and not have to make any payments during the winter? Or maybe you're in sales and you're a commission-based salesperson, and you really get nervous about those structured payments with the bank because you're worried that you might not have the money when the payment comes due because your income is so inconsistent. This is another benefit. Now, here's the cool thing about using the financial institutions, though. The financial institutions might offer you a lower interest rate, and they might not use your money as collateral, but if you still have your money available as collateral, if something did happen and you were unable to make that payment, then you could always use your insurance money, the money in your insurance policy, and the loan from the insurance company as a backup. So you could always use it as a backup plan if you were unable to make those payments. So that is very powerful as well as something to consider. Now, I keep clicking on this insurance company here, but what I want to point out here is that just because this strategy works really well with insurance products, it does not mean that you have to use the insurance company's money. You could always, use your savings account, your money market account, a CD, a 401k, a margin account, a HELOC, a credit union, a car manufacturer's loan, government loans for college, like savings for college. We talked about that last week. A signature year loan or an IOU. Heck, you might be able to get a parent loan from your parents for free and not have to pay any interest, which of course would be way better than using your money as collateral from a bank. So there are several ways to use other people's money and to get access to money, and you always want to look at that and consider the best route when it comes to to using that money. But there are several things to consider. Once again, you get to choose. That's the beauty of all this. You get to choose. So with that being said, the last thing I'll close with is what we call the efficiency enhancer. The efficiency enhancer is simply where, as you can see here, you have the same strategy, an interest-only loan, and then you accelerate the principal and interest payment. So you put more money in at a rapid pace into your policy over here that gives you extra cash flow. The extra cash flow fills the tank to the allowed limit, which gives you that maximum efficient contract, we call it, and it gives you additional money in there. So by replenishing the reserve account faster than would be required with that traditional financing option. For example, you go to a bank and you get a 5-year loan. Well, in this particular case, we could pay this loan off with the insurance company. We could pay this loan off in a matter of months if we wanted to, which of course minimizes the interest that we pay back to them on that loan. So of course it satisfies our lien sooner and allows us to remove that collateral quicker. And so that's just something to consider. So with that being said, as you can see, how you pay for things can be a very major wealth transfer. Using other people's money or going into debt is not always the most efficient, and using your own money and paying cash is also not always the most efficient. But as you can see, using your money as collateral so that your money doesn't stop compounding, that's the key. So that your money doesn't stop compounding anytime you have to use other people's money. Now, I want to close with this thought. I think this is a very fascinating thing to think about, is that in one breath, we talk about using somebody else's money as debt. When we borrow, money from, when we use our credit card, we use our credit card, and we, of course, consider that debt. We buy a car, and we get a car loan, and we consider that debt. But then when we're talking about using your money as collateral and using somebody else's money, we talk about it as leverage. And we talk about it as something that's smart, and it's a wealth creator thing. So what's the difference between borrowing money and considering it leverage and borrowing money and considering it debt? Well, the difference is with the leverage scenario, you actually have the money, and your money is growing, and it's uninterrupted. The compounding is uninterrupted. So your money is growing uninterrupted, and that compounding is continuing to grow, and you're simply using it as leverage, or you're using somebody else's money as leverage so that your money can continue to grow. But a debtor never actually has their money growing. All they're doing is paying interest. They don't have their money growing. So when you hear that debt is bad, but if you use somebody else's money as leverage, that's just being smart. And that's just, of course, what the wealthy do. So hopefully this has been helpful. Hopefully you understand the difference between debt and leverage. Hopefully you understand the power of uninterrupted compound interest. And hopefully you can see how this could be, I showed you the numbers earlier, of $300,000 to $400,000 over 30 years as a wealth transfer if you aren't efficient in how you make your large capital purchases. So with that, thanks for your time, and we'll catch you next time.